All right, traders, in this video, we're going to talk about the process of trading and really the ritual and routine that we want to go through each time we look at a price chart and each time we set up our trading day. And we call that process the IPDE process. So what is the IPDE process? Well, IPDE stands for identify, predict, decide, and execute. The first thing we want to do when we look at a price chart is we want to identify what is the market doing. We then want to come up with a prediction of, based on what we see, what would we expect to occur next? After we know that, we then want to decide on how we can approach the trading opportunity. And then finally, once we know all of the above, E stands for execute, which means pull the trigger and actually take the trade. So let's take a look at each of these steps in a little bit more detail, and we'll start with step one, which is identify. Now, the main question that we want to ask ourselves during this step is, what is price telling me about the markets? And that means looking at a price chart and asking ourselves a few questions. Asking ourselves, are we bullish, are we bearish, or in consolidation? So that means going back to our principles that we learned earlier about new structure high, new structure low, outside returns, higher high, higher close, back in the section where we talked about how to read and determine trend. Another question we want to ask ourselves is, where is our next level of structure? So in this example, we have a higher high, higher close above a previous level of structure. Well, where are we at in relation to our next level of structure? And the last question is, where are we at in relation to our previous level of structure? The next step is going to be the prediction phase. And after we have an idea of what price action is doing, what the overall condition of the market is, whether that be bullish, bearish, or in consolidation, the next question that we want to ask ourselves is, what is price likely to do next? And this is where we start to make a prediction. Now, our prediction is based off of the identification that we made. And if you remember in the chart, or if you're looking at the chart right now, you can see that price made a higher high, higher close. Now, going back to principles learned earlier in this training, new structure high, new structure low, higher high, higher close principles, the sections on how to identify a trend, we know that if we see a higher high, higher close, then we would expect, or we would predict, a continuation in the underlying trend. So based on this scenario, my prediction would be that price action will test previous structure resistance, those previous structure highs up at the red DSR zone. Why? Well, because there's really nothing else standing in the way of that level. Now, making that prediction tells us a lot. It tells us that if we want to be bullish, that's where we can expect price action to go. If we want to be bearish, that's where we can expect to look for a kind of a pause or some type of failure at that level. But we also want to ask ourselves another question. Not only where is price action likely to go, but how is it likely to get there? And what I mean by that is, it's one thing to make the prediction on where price action is going to go, or where we would predict price action to go. But going a step deeper and really making a prediction of how are we likely to get there allows us to start thinking about different trade scenarios and different trading opportunities, which will come in the next step. So when I look at the chart in front of you, I see that price action has made a higher high, higher close. My prediction would be a continuation to previous structure resistance up at the red DSR level. Now, I know that if my prediction is that price action is going to reach that level, there are two ways it can go about getting there. The first way would be that price action just continues to go bullish. We never look back. We go straight up until we hit that next level of resistance. However, another way would be the price action can retrace back to previous structure resistance, which is now support. That's going to be the green box with the red exterior. That level was once a level of resistance, once broken and closed above. So once violated, resistance now turns to support. We know that trends don't always go straight up. They kind of ebb and flow. They create new structure highs and outside returns, and new structure highs and outside returns. So one way would be to go straight up to that next resistance level. Another way would be to retrace back into structure, giving us an outside return before extending to that level. So those are the two predictions that I would make looking at the price chart in front of you. The next step is going to be decide. How do I involve myself in the trade? And a lot of this is going to be determined off of what type of trader you are. Are you a trend continuation trader? Are you a counter trend trader, right? But you want to go through that if-then thought process based off of the type of trader that you are. So let's say I am a trend continuation trader. I'm a trader that looks to hop on the trend. I'm looking for the extension legs. I'm not too concerned with the pullbacks. Well, in this situation, I would say if price action pulls back into previous structure support, then I will look for a reason for entry. And that reason for entry could be a double bottom. It could be a higher high, higher close. It could be a specific candlestick combination. We don't want to worry too much about the details right now. More so the bigger process of coming up with that if-then statement and knowing what side of the market we want to be on. So again, if I'm a counter or if I'm a trend continuation trader, then I'm looking to buy at the retested structure in anticipation that we'll see that extended leg up to our level of resistance. If I'm a counter trend trader, so a trader that's looking to go against the trend, instead of looking to buy the expansions, I'm looking to just get involved with the pullbacks. Well, then I might say something like this to myself. If price action reaches our next level of structure resistance, that nice, beautiful red box up there, then I will look for a shorting opportunity. So you see, no matter what type of trader you are, we have a way to get involved in this trade. And well, some traders may be both. You may have a reason to get involved in anticipation of the move and then actually at the price point that you predict as well. Now, the last part, E, is execute. And this may seem like the easiest part. Wow, there's no other bullet points underneath this, just a big sign that says pull the trigger. But I'll tell you what, this is where trading psychology comes in hand, because many traders will do the first three steps completely right. They will identify what the market's doing. They will predict where price action is likely to go next and how's it likely to get there. They may decide on how they want to involve themselves in the trade. They may have everything ready. But when it comes to the time to actually take the trade and push the button, they freeze up. They hesitate. Maybe they enter early because they lack discipline. They don't want to miss the move. Maybe they enter late because they're scared. The previous trade was a losing trade, and this one feels like a losing trade as well as that big red candle comes down and they're supposed to buy, right? The simplest rule, execute. But many traders will run into trouble at this part. This is where you really have to trust yourself. You have to trust your plan, and you don't want to waste all of the hard work that you put in before. So that's the IPDE process, guys. Identify, predict, decide, execute. We're going to head over to a price chart next, and I'll give you a look at how I like to do it using multiple time frames and really the ritual that I go through each and every day when breaking down a price chart looking for trading opportunities. All right, so let me walk you through how I go about my IPDE process when looking at a price chart. And the first thing I would say is this: when I go through this routinely, I like to break the process down in half. So I like to do the I and P, the identify and predict portions, on my higher time frame. So the time frame that I'm using to get a bird's eye view of the market, a bigger perspective of what's going on. And then I like to do the D and the E, decide and execute, on my actual trading time frame. So time frames where I can actually execute the trades. So let's take a look here. This is gold dollar, and we're going to start on the higher time frame for me, which is the daily chart. And I want to start off by just taking a look at what gold has done. We have recently been in an upward move, so an uptrend right here. We've chopped around a little bit, but you can see we're continuously making higher highs and higher lows. We finally get to a top right here where you can see we start to base off, right? Market consolidates. We refuse to create a new structure high. We consolidate for a while before crashing down, breaking and closing below our previous outside return. So if I look to label this, this is going to be my starting point up here. This is going to be my initial structure low. We then put in an outside return, and we follow that up with a new structure low. So it's at this point where I could say higher time frame, looking at gold dollar, we are in a bearish trend. We just broke our previous outside return. We also broke another significant level of structure, broke and closed below, I should say, another significant level of structure. So my identification is we're in a we're in a bearish trend. We just created a new structure low, and currently price action has made an outside return. So the next step is my prediction. Well, now that I know that we're in a bearish trend, right? I ask myself, well, which way is the market likely to go, right? Where is the market likely to go next? And well, my guess would be downward, right? We're in a bearish trend till price action shows us otherwise. My prediction would be that we're going to continue in that bearish trend, and we're going to, if we caught it right here, our prediction is that we would see an outside return, right, or an outside return to previous level of structure. Since we already have this outside return, my prediction would be that we either come back down to retest previous structure lows, or we come back down, we surpass previous structure lows, and extend it to our next level of structure looking left. But either way, I'm predicting a bearish move, a bearish move, a bearish move. And what that means for me is when I start my trading day, when I look at this chart, I've just eliminated half of the battle. A problem that many traders go through is they get sort of this analysis by paralysis going for them, when they look at a price chart and they see so much, right? This is going on and that's going on and this looks bullish, that looks bearish. So many ideas are going through their head that they kind of get ideas for both. Well, I can buy right here. Ooh, I can sell right there. Or this can be a buying opportunity. Oh, no, that could be a selling opportunity. And they freeze up. And I'll tell you what, that's natural. If you're skilled enough and if you want to, you can create a buying or selling opportunity based off of pretty much everything you see in the market. So the key for me is when I look at a price chart, I want to eliminate half of those thoughts. I want to have an idea by the time I get done with my higher time frame. I want to have an idea of what side of the market I'm looking to get on. And when I do the analysis like this, I only want to get bearish. I'm only looking for bearish opportunities. Why? Because I've identified that we're in a bearish trend. My prediction is that we're going to go lower, again, either to this point right here or a continuation, an extension. But either way, I'm looking bearish, bearish, bearish. And that kind of sets up my mindset for the next part. So now that I know that I want to get bearish, the next question I need to ask myself is, how can I get bearish? How can I get bearish in this market? And I'll kind of break this down. We'll do it from a trend continuation standpoint first. So how can I get bearish in this market? And this is when I have to decide. So what I would do is I would go down to my lower time frame. In this case, is going to be the 4-hour chart. And I would ask myself, or I would go through my trading plan and see, oops, wrong chart. Sorry about that. 4-hour, not 3-hour. I would go through my trading plan and I would ask myself, what opportunities, what strategies, or what systems, techniques do I have to get involved in a bearish market? And I'll look at this price chart and say, well, we just had an outside return. Our outside return came to previous structure. If we want to bring some Fibonacci's in as well, looks like we'll have a 382 Fibonacci extension, swing high to swing low. All right, look at that. Price action came into a 382 Fibonacci retracement, which is the strongest retracement as far as trend continuation would go. It's a very shallow retracement. If price action respects that level, it should mean a stronger trend than a weaker one. So we have a Fibonacci retracement right there. If I draw a line in, right, we've come back to test that previous level of consolidation where price action found structure a few times in the past. And it looks like right now we've double topped. Now, to some traders, the double top would have been enough for an entry. They could have seen an initial test and hold, right? The market retraces off that. We test again and it holds again. That could have been a short entry. But being realistic, I didn't see that when it happened. So right now I'm involved in the market as is. So the double top has passed. How else can I get involved in this trade? So I need to decide. So I go to my trading plan. I flip through. What did I learn? What did I learn? What are techniques? Okay, double top. That is a technique I can use to trade. However, the double top is already passed. So what does it say in my trading plan? Well, if you miss the double top, the next trading opportunity that you should be on alert for is a 2618. There we go. So I look at this and I say, Well, we have our double top right here, right? Double top has been formed. We draw this in for you guys. Double top has been formed. We have our lower low, lower close. Let me see if a 2618 is still valid. So I take my Fibonacci retracement on, bring it on from swing high to swing low. And I say, you know what? If price action, right? If price action makes its way, there we go, back to the 618 retracement, then I can enter short on a 2618 opportunity, something like this, in anticipation of price action going lower. And that's going to be how I hop on a trend continuation trade. Does that make sense, guys? So you can see we originally started on the higher time frames, just not looking for anything specific, just looking for an idea of how we want to approach the market for the day or for the week, depending on if you're a higher time frame or a lower time frame trader. And then after we've identified what price is doing, after we've made our predictions and have decided what side of the market we want to be on, then we go down to our lower time frame and we actually look for an entry reason. And then, of course, the last step, well, if price action does make it to this level, well, I've got to pull the trigger. I've got to be willing to take the trade because, again, all of this analysis will mean nothing if I don't involve myself. So that's a good example of how I would approach it as a trend continuation trader. A counter trend trader would be a little bit different. Essentially, you would do something like this. I'll see if I can find an example of one, but you would go in your back to your higher time frame, right? Your prediction is that this is going to be the first stopping place for price action. So in this case, as a counter trend trader, right, once you go down to your trading time frame, you would have to wait until price action gets all the way down here to this level, right, to your previous structure support, and then decide, well, if price action gets to this structure support, how can I enter the trade? And you go through that same if-then thought process. If, and then of course that means scrolling through your trading plan and seeing what type of techniques you can use, but I'll give you guys a quick example. If price action comes to previous structure, then I look for RSI to be overbought. If RSI is oversold, excuse me. If RSI is oversold, then I look for double bottom. If I get a valid double bottom, then I enter long. So you can see it's the same thought process. And in this case, because we've already had our outside return, you got to wait a little bit longer. But it's the same idea of getting a step ahead of the market and going through that process. Yes, we're in a bearish move. So instead of trying to get bullish right now, where is the next opportunity for me to get bullish at? That will provide me an edge over the market. So let me see if I can find one more example and walk you through another opportunity to teach the IPDE process. All right, so let's take a look at another example. And this one is a little difficult. Traditionally, you usually want to give nice, clean, easy examples in these videos. But you know what? This is practical application. This is what you're going to see in the live market. So there's no need to sugarcoat this stuff. There are going to be situations where the market is tricky and you need to know how to break it down. So what we're taking a look at here is the euro pound on the daily chart, and I'm going to show you how I would go about the IPDE process on this chart. Now, as you can tell, price action isn't as clear as what we just looked at on gold. Gold was a pretty smooth break and close below structure, followed by a very nice outside return, making it very easy to predict what's going on. Euro pound here is a little bit different, right? The market is moving pretty nicely in an uptrend here. And we certainly are still in a bullish trend. However, right, we've created a new structure high right here, and then we've kind of almost had a double top, and then we've come back down to test previous structure lows, our previous outside return, and then we've come back up to retrace, but didn't quite get to our previous structure highs, and now we've consolidated again or retraced again. And again, technically, this is still a bullish move. Our outside return has not been violated. But I think we can all agree that it's not as crystal clear as what we saw in the last example. So when I identify this trade, I still identify this as being bullish, right? We are in a bullish trend, but I also know that price action has gotten a little choppy. It looks like it's heading towards consolidation, so sideways movement in the market. So the first thing I want to identify is or the first thing I want to identify is where are my key levels of structure. And if you have the DSR levels on, it'll probably print them for you. I'm on TradingView right now, so I don't. But I see our previous structure lows right here. This is an area that the market hit 1, 2, 3 times. We kind of shelved off right there. And then, of course, our previous structure highs up here. So I identify the market is in a bullish trend. However, we're trading sideways at the moment. Our key levels of structure are below, down at this level right here, and above, up at this level right there. So the next thing I want to do is make a prediction. Where is price action likely to go next? And it's going to be one of these two structure levels. Again, I don't know. If we make a downward move here, we're most likely to retest our previous level of structure once again. If we continue higher, we're most likely to retest this previous level of structure. But right now, I don't know. And this is important because there are going to be times in the market where you just don't get a clear picture. The price action is going to trade in what seems like the middle of no man's land. And there's going to be that desire to always place trades. And sometimes there just aren't trading opportunities to be had. Sometimes the best trade is no trade. The best trade is where you sit back and you wait for price action to get to a level of importance for you. And that's exactly what I would do in this scenario. So I would tell myself that, okay, well, my prediction is that we're going to test one of these levels, either support up down here or resistance up here. As of right now, I have no idea. So I'm going to sit back and wait. I'm going to make some predictions, or I'm going to make some predictions on, or decisions, maybe I should say. I'm going to make some decisions on how I can get involved if price action does get to one of those levels. That way, if we do move, I'm not caught off guard. The market doesn't surprise me. I'm not sitting here watching price action hit a level and I'm freaking out because I don't know what to do. I'm going to set up and decide in advance how I can get involved if either of those levels are hit. And if they are hit, I will execute the trade. If they're not, well, I do like what we do most of the time. I right click and I delete my analysis and start over again. So let's head down to my lower time frame. Again, all those decisions are made off of the higher time frame. Let's head down to the 4-hour chart and let's see if we can make some decisions here. So let's say our first one was we're going to predict price action going down and retesting a previous level of support. I may do something like this. I may zoom in here and I may look at what is our last move. What is our last move? Well, the last move price action has made has been from our swing high right here to our swing low. Now, what if we put in an equal to measured move? What if we put in an ABCD pattern? Where will that put us? Well, if I connect it right here, look at that. An AB equals CD pattern will put us right at those structure lows that we've identified on the higher time frame. Is there anything else I can do here? Well, I can take my Fibonacci extension tool from this A leg to my B leg and right back up. And look at that. I'm going to have a 1618 Fibonacci extension down at that same area. Now it's not exactly lining up with the one-to-one measured move, but we know that the markets work in zones, so they're not always going to be exactly correct. But I have this area that I can start paying attention to that comes down in that zone that I identified or identified on the higher time frame. Then you can start putting your trading plan together. Again, scroll through your trading plan. How do I trade ABCD patterns? How do I trade CTS, combined technical score, for you guys that have learned that? Is it just enough to have price action hit this level, or do I need to wait for confirmation? Do I need the RSI overbought? Do I need a double bottom? Can I enter on simply a higher high, higher close candlestick formation? Whatever it says in your rule book, whatever it says in your trading plan, you start flipping through those pages and deciding how are you going to attack this trade. And I'll tell you what, if you can't, if there's nothing in your plan that tells you how to trade this, then it's a no trade. Now, vice versa, if price action goes up, well, how can I take advantage of a move up in this area? And there's a few things you can do. Obviously, we can kind of do what we did with the gold trade we talked about last. Just wait to see if price action, let's do it like this. Let's delete all this stuff first. You can wait to see if price action gets up to that level and then simply look for a shorting opportunity. So wait for a move like this. Oops, if I don't delete it, Akil, come on. Wait for a move like this. Wait for price action to get to this level and say, okay, well, if RSI goes overbought, then I wait for a double top. And, the same thing we've discussed in the past. Or say you're someone that is familiar with advanced pattern formations, you could do something like this. You can take your Fibonacci retracement from your swing high to your swing low right here. You could say that this looks to be setting up an advanced pattern formation. This is going to be called the advanced bat formation. And if you don't know about this already, don't worry about it. We'll discuss it in a later part of our session. But it's basically a trading strategy in itself, advanced pattern formations. And it would complete right here, which is essentially right at that higher level of structure resistance that you looked at. So now you already have a reason to take the trade. Most advanced pattern formation traders enter aggressively, meaning that they put a sell limit order. In this case, they would put a sell limit order right at the D completion. So now you know if price action goes up to that previous level of resistance, then I'm going to enter aggressively off a sell limit order due to the completion of an advanced bat formation. So you can see right now, although price action isn't really doing much, right? We have trading ideas for both sides of the market. If price action goes up, I know exactly how I want to trade it at the higher level of resistance. If price action goes down, I know exactly how I want to trade it at the lower level of support. And now it's simply my job to wait until the market tells me and shows me, I guess you could say, what it wants to do. I'm not here to chase the trade. I'm not here to say I got to buy it in advance of that because I know it's going to happen. We don't know what's going to happen. I don't want to buy it right now in advance of the move up because I don't know the move up will happen. I don't want to sell it right now in advance of the move down because I don't know what the move is going to happen, right? The only thing I can do is decide how I'm going to attack it if price action reaches those levels. And until then, I just wait. So that's the IPDE process, guys. Again, I go through this every single time I break down a price chart, identify, predict, decide, execute so many times a day. But I'll tell you what, when you're able to make this process a routine, make this process a ritual, you're going to be a lot more comfortable in your trading, and you're going to be able to filter out the good and the bad trading opportunities pretty quickly. All right, so before I let you go, of course, I have to leave you with some action items. I couldn't leave you guys without telling you to train the brain, train the eyes on this stuff. So here's what I want you to do. I want you to go through at least 10 charts, minimum. You should be going through 20, 30, 50, however many it takes, but at least go through 10 charts and work on doing and working through this IPDE process. It doesn't matter what the pair is. It doesn't matter what the time frame is. It doesn't matter whether you have open space to the right of your screen or if you're going through, say, historical data in the past. I just want you getting used to, right, growing that routine, building that ritual of going higher time frame, identify, predict, lower time frame, decide, execute. Higher time frame, identify, predict, lower time frame, decide, execute. And I'll tell you what, you may not have rules right now on how you would decide and execute the trade, but it's okay. Just pretend. You guys know enough now just to say, okay, well, if something like this happened at this area, this could have been a way I entered. But more importantly, again, I just want you guys establishing the process of blocking out half of the analysis. So determining if you should look to get bullish or bearish, obviously depending on if you plan on being a trend continuation or a counter trend trader. Or actually, you could just do both. Say, if I were a counter trend trader, then I would be looking for this. If I were a trend continuation trader, then I would be looking for that. Just get into the charts, mark them up, practice, practice, practice. That's the easiest way to build the skill of reading a price chart. So you guys do that, and I'll see you in the next training lesson.